The topic of this webinar is cash and debt under COVID-19. Here's a short overview. I mean, that's obvious. We will first talk about including the valuation of debt into corporate valuation, which has become an issue under COVID-19. And then also something that has popped up a bit more under COVID-19, that is a different look at cash, because now some firms are happy that they have had excess cash that they can now use in order to cover the losses and cover the cash outflows, whereas others don't have excess cash at hand. And so the question, of course, arises, is this an issue that we should include into corporate valuation, the different, let's say, look of cash, yeah? Okay, let's start with debt, yeah? Here is my personal list of interesting questions. Of course, this is not complete, and we are happy to any topic added by you. The first, and I think the most obvious question is the distinction between market and book value, because of course, in theory, you should deduct the book value of debt, the market value of debt. And of course, it is a bit tricky to calculate this market value. Many use the book value instead, and the question is then, what are the reasons for differences between the two, and is this distinction actually really relevant under COVID-19? Yeah. The second question is that arises is, of course, that in many cases people ask the question, it's not just about the current debt, it's also about future debt. And of course, the question that arises then is, will the firm be able, under uncertain conditions, to keep up the current level of debt, or will it have to reduce the debt? And shall we take this into consideration when calculating the value? And if so, how? Yeah. And the third, and I think the most trickiest question is how to value risky debt and how to take risky debt into account. And that, of course, relates to the question, distinguish between credit risk and bankruptcy risk. Is it important to do so? And of course, the question, especially if interest rates are very high due to high credit risk, is this high interest risk actually supposed to be equal to the cost of debt as we use it, for instance, in the WACC approach? Yeah? So these are my favorite topics and questions. And let's start with potential reasons for a difference between market value and book value. Yeah? The first one is a pretty old one, and that is changes in market interest rates. Of course, may affect the market value, but of course do not affect the book value. Yeah? So we have seen this quite a while ago, especially in Germany. After the reunification, we had a very, very high level of interest rates. And then we observed, of course, this decline. And since the early 2000s, we are in a low interest rate environment. And of course, if you have debt outstanding with a very long time to maturity, then of course, this long time to maturity, of course, may then affect the market value of debt, because you then have to discount the future cash flows out of this debt with the current market interest rates over the current term structure. Yeah? So as I said, as we have had low market interest rates for quite a while, this is not that important anymore. So usually you measure this risk of changing market interest rates and the impact on bond prices and the market value of debt by this famous concept of duration. The duration is then measuring the sensitivity of the market price of a bond or of the market price of debt with respect to a given change in the market interest rate. Yeah? So it tells you the percentage change of the bond price if market interest rates go up or down by a certain range or by a certain percentage change. Yeah? So this is trivial in a flat term structure. It is not so trivial in a non-flat term structure, because there is something that is called like a process risk. that particular versions of this duration are only valued if there is a particular shift in the term structure, for instance, a parallel shift or a multiplicative or an additive shift. But that's more something that is interesting for banks to manage their interest rate risk exposure. But I do not think that this is too important for corporate valuation, at least not in the current long-term low market interest rate environment. Way more important than the COVID-19 is the second source. That is a change in credit risk. Yeah? So the first thing that of course comes into mind is an exogenous shock like COVID-19. Yeah. So, and that yields a change in the creditworthiness or the credit risk after the credit was paid out. And that of course means that the old conditions do no longer hold. And the old conditions of course drove the credit conditions, and the creditworthiness then is of course no longer valid under COVID-19. Yeah? And that of course has an impact on the market value of debt, yeah, because then of course the market value of debt is no longer the same value as it was when you agreed upon the credit conditions. Yeah. So, but before you sit down and calculate a new market value of debt by using the cash flows under the old terms and discount it with a risk-adjusted and appropriately risk-adjusted discount rates and market interest rates, I found out that it's quite important that you first have a deeper look at evaluating to the credit terms, because sometimes the credit terms already contain a potential reaction of the bank on a worsening of the creditworthiness of the firm. For instance, by automatically increasing the interest rate. Yeah. But when you look at the bond market, you find sometimes so-called rating triggers that automatically, for instance, adjust the market interest rate or the interest rate on the bond, the coupon rate that the bond has to offer, if this bond is downgraded by the rating agency. Yeah? So in that sense, or in this case, the change in the creditworthiness is reflected in the adjusted additions and the adjusted conditions and interest rate of the bond, and not by adjusting the market price. Yeah? So that's important. So if the credit terms include such an adjustment of the interest rate of this financial instrument and of the credit, then of course you don't have to adjust the market price and the market value of this step. Yeah? But if this is not the case, so if the old conditions are going to hold and the bank is not able to change that via the credit terms and the contractual terms, then of course you have to recalculate the market value of debt under the new conditions by taking the old, in that sense, cash flows that are attached to this credit and find new risk-adjusted, reflecting the current risk-adjusted discount rates and interest rates. Yeah? There is, if you look at bond markets, an endogenous change in the credit risk of the bonds that is well known from the bond market, the so-called pull-to-par effect. That is, if the debt is risky and the credit or the bond is risky, then the lower the remaining time to maturity is, the lower the credit risk becomes. And so simply through the passage of time, the credit risk of this particular bond is going to decrease, and that is then yielding the result that the bond price is then moving towards the final and the book value and the down payment of the bond finally. Yeah, but that's less important. So the most important and most obvious is a change in the credit risk without the ability of the bank to adjust the interest rates on the existing credit contract. Yeah? So what is important, and that, for instance, may yield that, of course, the market value of debt is lower than the face value or the book value of debt. Yeah? And the question then arises, of course, on whether this has an impact on the market value of equity. And of course it does. Yeah. So in that sense, it increases the market value of equity Because, of course, if you would arrange a new credit under the new market conditions and under your current creditworthiness, of course, you would have to pay a higher interest rate. Yeah? And that, of course, the old interest rate under the old better terms is then a benefit that increases the value of your equity. Yeah? So, and that is independent, because recently we had a discussion with some practitioners on this topic, that is independent on whether you can, in that sense, enforce the immediate down payment of debt. Yeah? Because the argument that we had on the other side was that, in that sense, while not being able to pay down the lower market value debt, you cannot, in that sense, cash in that benefit. But that's not, in that sense, necessary, because the present value of the saved interest payment is still increasing the value, no matter on whether you cash it or are able to cash it in immediately or whether you aren't. Yeah. So in that sense, I think it's worthwhile to note here that it is not necessary to immediately down pay the debt at the lower market price or the lower market value to get that benefit on the equity value, because, as I said, the present value of the saved interest payments is still a benefit that increases the value. Yeah? So there is an issue, at least I'm personally convinced and deeply convinced, unless otherwise told, that this is actually only a minor problem, because it just relates to the debt that is currently outstanding. Yeah, because I think it's a valid assumption that you assume that if this old debt is then completely paid down, the new credit, of course, that you take on then is, of course, reflecting the then prevailing creditworthiness. Yeah? And a good assumption on this is that the new credit intakes technically have zero net present values. And that means that the debt holders will, of course, charge a risk compensation interest rate depending on the then prevailing future creditworthiness. Yeah? And so, in that sense, my personal feeling is that the problem shrinks significantly if you just look. I mean, my feeling is that the average time to maturity of outstanding debt in Germany is somewhere in between 2 and 3 years, and so I do believe that the impact of this question market value against book value, as it just relates to the currently outstanding debt and not to any future credit intake, is rather small. Yeah. So that, as I said, unless otherwise told, that's my firm and personal belief on this. Yeah. So I personally think that the APV approach, which I've learned, and I'm happy to learn, that is quite popular in the Netherlands, is very well equipped to avoid some serious problems in the valuation of this debt. Yeah, because only the current debt is potentially to be adjusted, and as I said, in the APV approach, you don't have to care about any future credit intakes as long as you assume that the credit conditions to hold then will fully reflect the creditworthiness of your firm. Yeah. So, and that means that, as I said, you don't have, in that sense, don't have to particularly care of future credit intakes. But of course, still the question is open: will the firm be able to, in that sense, keep up the current level of debt? Will it still have the same access to bank credits and the same level in the future if the current debt is down paid? Yeah, and that is, of course, a question that cannot be definitely answered, because it depends on the future creditworthiness of the firm. Yeah, but as we have shown elsewhere, there is a nice way to, in that sense, include this uncertainty into the corporate valuation by defining a particular financing or debt policy. Yeah, and this financing and debt policy consists out of two components. The first one is a certain, in that sense, target leverage ratio that attaches the future debt level to the future value of the firm. And the second component is a certain, in that sense, a certain time to maturity. And the idea is then that you say, by fixing these two components, the leverage ratio and the time to maturity, you always assume that if the firm value has, for instance, decreased by 20%, then of course the debt level for the new debt also will decline by exactly the same 20%. Yeah. So in that sense, your future credit intakes will depend on the future development of the firm, and that means that you can include this quite nicely in the APV model by calculating the tax shields appropriately for a certain given financing policy. You probably all know this standard financing policy from in this Miles-Etzel model, which simply assumes that every year the debt level is exactly adjusted in the same manner that I just described. Yeah? That you always multiply a certain target leverage ratio with the then prevailing value of the company. So the benefit number one of this APV approach is then you don't have to make yourself ahead about future risk-adjusted interest rates. Yeah. Because as I said, your creditworthiness in the future, in that sense, will just be reflected by the net present value in this case. Yeah? Whereas in the flow to equity approach, of course, you would make yourself ahead about the future interest that you have to pay, because in the flow to equity approach, you rely on the flow to equity, and that of course is after interest rate. And so in that sense, in this approach, you have to make yourself ahead about the future risk-adjusted interest rates. Whereas in the APV approach, you don't have to do that. Yeah? And the benefit, the second benefit of APV against the WACC approaches, of course, as by definition, the first step in the APV approach is to calculate the value of an all-equity financed firm. You just need to know the cost of equity of this all-equity financed firm. Yeah. So, and you don't need to make yourself ahead about the future risk-adjusted cost of debt. Yeah? The disadvantage is there is one spot in the APV approach where you have to make yourself ahead. That is when you calculate the future tax savings. Yeah? And if you calculate the tax shield. But if you just look at the contribution of the tax shields to the total value of the firm, I firmly believe that this is a smaller, in that sense, risk of working with wrong cost of debt than compared to the other two approaches, WACC and flow to equity. Yeah? So this is a copy of a slide of my lecture slides that I think is quite important, because it shows that we have to distinguish between bankruptcy risk in the valuation on the one side and credit risk on the other side. Yeah? And if you stay in the entity world, then under ideal conditions, credit risk is irrelevant for the entity value of the firm. Yeah? And this table is going to highlight this. So it's a famous paper, I think, by two researchers, Haugen and Senbet, published in 1978. And the idea is the distinction between the liquidation decision, and that is you calculate the value of the firm under liquidating strategy and compare it against the value of the firm under continuing operation strategy. And on the left-hand side here, in the second dimension, we have a trigger of bankruptcy. I simply took over-indebtedness here as a trigger. That is, we compare the value of the assets against the face value of debt. Yeah? And under ideal conditions, you see here that the bankruptcy, yes or no, is going to, in that sense, make sure who is going to decide how to use the assets of the firms. Yeah? Whereas here, the decision itself, liquidation and continuing operations, is then still independent under ideal conditions on who is actually going to make this decision. Yeah. So in that sense, you see here, if the firm is not bankrupt, then of course, still, if the liquidation value is higher than the continuing operation value, then still the owners of the firm decide to liquidate. If the other relation here is going to hold that the owners decide for continuing operations. And now, in that sense, theoretically, bankruptcy is then simply handing the decision power of how to use the assets, or whether liquidate or continuing operations, from the owners of the firm to the debt holders of the firm. Yeah. So in that sense, under these ideal conditions, even bankruptcy is irrelevant for the valuing of the firm, or for the entity value of the firm. And the second important conclusion from this is also, as long as debt holders are able to see their risk and to properly judge their risk, the credit risk itself is reflecting the credit conditions. And as the credit conditions fully reflect, in that sense, the credit risk itself is also irrelevant for the valuation. Yeah? So in that sense, these two things have to be made clear before we actually enter into any discussion on liquidation costs or bankruptcy costs on the firm value, and credit costs. So as I said, in the entity world, credit risk itself is not relevant for the valuation of the equity, as long as the credit terms fully reflect the current creditworthiness of the firm. Yeah? And if the creditworthiness is going to change and the bank is not able to adjust the interest rate, then the market value of the debt is then departing from the book value, and then through the back door, this has an impact on the value of the equity. Yeah? By the way, it can also go the other way around. So for instance, if the credit risk is going to decrease over time, and if you would go to the market then and now get a lower interest rate, but if you're still stuck with the old credit conditions under the higher credit risk, then when you organized and took in the credit, then of course this has a negative impact on the value of the equity, because now the market value of the debt is higher than the book value. Yeah? Okay, so let's now have a look at pricing of risky debt and cost of debt, of risky debt. Yeah. So we start here with the bond yield. Yeah. So here's a simple example of a bond, and you see the bond has a coupon rate of 6%. So you see here the payments of the bond, interest rate 6 every year, and then here redemption, a bullet payment at the end, plus interest. The firm does not very well in this example, so there is an increase in credit risk, and that yields, of course, to a lower bond price. You see that the bond is trading below par, so the current bond price is 70. And now the yield of this bond is simply the internal rate of return by combining these payments that are attached to the bond with the lower bond price. Yeah? And you see, due to the drop in the bond price, we get a significant increase of the bond yield, and the significant bond yield, or significant IRR that is significantly above the coupon rate. Yeah, it's now 16.9%. Yeah, and of course the question is then on whether this 16.9%, which is the bond yield, is a good estimator for the cost of debt of this particular firm. Yeah? And I'm quite sure that the answer on this question is no. Yeah, and I produced a little video on my YouTube channel just to highlight this. Why is this not a good estimator for the cost of debt of the firm? Because if you look at this, you combine the promised payments that the bondholder gets if everything goes out fine with the decline and the lower bond price. Yeah, and that, of course, these 16.9% is what you get if everything goes out fine. So in that sense, it's good to label this as the promised yield. Yeah, but of course, as the market price of the bond already properly suggests, there is a significant probability that you will not get what is promised. Yeah? So you will not get the 16.9% if you buy this bond for 70. Yeah? So what you have to take into account if we talk about cost of debt, you have to take into account that with a certain probability you will not get the money back. Yeah? And so if we loosely speak of cost of debt, what we actually should have in mind and bear in mind is the expected rate of return and not the promised one. Yeah. And the expected rate of return, of course, properly takes and shall take into account the probability that you are not getting what is promised. Yeah. And so in a simplified example, if we say that with 95% we get what is promised, so with 95% we get the 16.9%, and with 5% we get nothing. Yeah, so in that sense there is no, the recovery rate is 0, and then of course we lose 100% of our invested capital. Yeah, and so what we actually would need to know is this expected rate of return on our debt, and that is, as you can see, is significantly lower. It is just 11.05% in this simplified example. Yeah? The example is simplified because what we actually would need in order to properly calculate RD as an expected rate of return is an option pricing model. Yeah? So usually you need a Merton model or a Black-Scholes model to properly price risky debt and calculate RD as cost of debt. Yeah, so this is just a simplification, but I think it highlights the effect that the problem is becoming larger and bigger, the distinction between promised yield and expected rate of return, the riskier the debt becomes. Yeah, I mean, if you have a AAA debt outstanding, then AAA rating, then the distinction between expected and promised rate of return on debt may be negligible. But if you have a C rating or even a BBB rating, then things start to get important, and then you have to distinguish between these two things. Yeah. So we have prepared a little Excel example how to use simulation-based modeling in order to come up with an appropriate price for risky debt, and that is the point where I would like to pass over to Max Schreiter to show his little Excel model on this. By the way, we offer Excel training classes, also jointly with NIRV, to, in that sense, cover these theoretical backgrounds and combine it with some Excel specific applications. Yeah. Okay, so Max, I hand over to you, and you are going to continue.
Yeah, thank you very much. Yeah, so it will be now my pleasure to at least give a glimpse of how to model risky debt in Excel. Just before we do that, too little information. So you guys probably saw that I was sharing a poll with you just to figure out who has been already in the first meeting. The majority of you have been, which is good because this idea of creating geometric random walks is something which we are also now going to use. Yeah, that's the root, so to speak, or the backbone of any simulation model, and basically also the backbone of the famous Black-Scholes option pricing approach. Yeah, so we unfortunately don't have time to go deeper into that idea of a geometric random walk again, but for everyone who has not been in the first webinar, you can obviously get the link to the first webinar and also have a look on that one if that's something that interests you. The second question that I asked was basically whether you have ever used simulation-based models or option pricing approaches and evaluation approaches. And it seems that roughly half of you have rarely or sometimes used it, and half of you have never used it. And that's pretty much what we see throughout all practitioners whenever we do such seminars. So therefore, I'm now glad to show you a little bit how such a simulation model can be implemented for risky debt. just for a moment longer, I will stay on that slide here that Professor Schweitzer is still sharing, and then I will jump into the Excel model. But I think the slide is good to give you a first overview about the modeling idea. Yeah, so what's behind here is basically saying we have an EBITDA of a company which is uncertain, yeah, follows a certain random distribution, a so-called geometric random walk. That means that the growth rates or the changes of this EBITDA is log normally distributed, or you could also say the log changes of the EBITDA are normally distributed. Yeah, so maybe at least that you have a little bit of an idea what that means in terms of a distribution is that it pretty much looks like a bell-shaped curve, like a normal distribution, but it is a bit fatter on the tails of the distribution, and it is a little bit skewed to the left. Yeah, and that's something where people have found out that this matches empirically much better than a regular normal distribution. Yeah. Other than that, the parameters are pretty much the same as a normal distribution. You have a certain drift rate, yeah, so an expected growth, and you have some volatility around it. Yeah. In our example, that's basically a drift rate of 2% and a volatility of 20%. Yeah. Other than that, the assumptions are pretty much standard from what you know from corporate valuation. We have a risk-free rate, we have some unlevered cost of equity. Both are needed to make this shift into the risk-neutral probability world, which I'm not going into too much detail now. Then we have a certain cost of bankruptcy. Yeah, so that means what is basically lost in asset value if the company defaults. Yeah, Professor Schweitzer talked about that. There are many empirical studies on that. At the moment, people believe that a mix of direct and indirect bankruptcy costs may, let's say, overall industries be something of like 25 to 35%. But that's heavily dependent on the industry. Yeah, so we will have industries with long-living goods, or where long-living goods are sold. Then we basically have much higher bankruptcy costs than, for example, if you sell paper tissues. Yeah? So in my example here, that's 40%, and then we have a debt contract with a nominal debt level of 40. There is still a time to maturity of 7 years, a promised yield of 5%. So this is what you really see in the credit contract. And there is a certain covenant attached to the debt contract, which is a debt to EBITDA covenant. So that's the classic, banker would call it the leverage covenant. And this is debt to EBITDA of 6. Yeah? So that means as soon as the debt gets higher than 6 times of the EBITDA, the debt basically defaults and has to be paid back, and this cost of bankruptcy occurs in this little example here now. Yeah? And it's obviously a debt contract that has started somehow earlier than today. Yeah? Something that is already running but has still 7 years, let's say, on the clock. And in that setup where the company stands at the moment, the market value of debt is not 40, but it's 35.64. And the reason is basically that the promised yield is too low to really make it a market value that equals the book value of debt. Yeah, so that's the overall story. What else do you see down there in the results section is basically then also an expected return of debt. Yeah? So once you have calculated what is the market value of debt, and I will show in a second how that works, at least roughly. But once you have that, you can basically calculate back what is the expected return of debt. That's nothing that is written down in any contract. That's really something that comes out of the difference of market value of debt and book value of debt. Yeah? And in the very last cell, you see the cumulated default probability over those 7 years. Yeah? So at the moment, as the setup is, there is a pretty material risk of default, which is roughly 33%. Yeah, so that's just to kind of explain the overall setup. And now I'm sharing my model. Just one sec. Okay, so I now hope I hope you see now the model, but it should work fine. Yeah. Okay, very good. So again, all the data you see here is the data which you saw on the slide, and now I just quickly want to show you the structure of my really little example. Yeah. So I have basically created a lot of random paths here. So yeah, so that's the simulation. I think overall, let me see, we have 10,000 paths over here. All of them start as an EBITDA value of 10. And then I'm not going into the detail of this formula here, but this is basically the formula of the geometric random walk. And it consists, let's say, of this drift term, which is 2%. Yeah, so that's the expected growth rate, and the volatility. And the volatility is then basically multiplied with a scaling factor for time, but also with a random number. And those random numbers, they have been created over here in this third table, and the formula you can see here. Yeah? So a random number in Excel can be created with the rand function, and then you can transform it into a normally distributed random number with this norm.s.inf. And then what I always do is I do that for all the years and all the paths, but then I basically paste values to make sure that at some point in time, we basically have always the same paths and not changing paths from calculation to calculation. Yeah, so therefore all those are now hard-plugged numbers. Okay, and then we can create basically those random walks or random paths. And I think I have also depicted them here in chart number 1. Yeah. I guess not all of them, but probably like the first 100 or something like that. So that you basically see that graphically. Yeah, so we can come up with random paths, which we can now use to figure out how many of those paths are running into default, and at what point in time are they running into default. And if we would now make a histogram out of those random paths, you would basically see such a bell-shaped curve, yeah, which, as I said, has just some fatter tails and is a bit skewed to the left. Yeah, I fear I was, yeah, sorry, I was a bit lazy. That would have been one chart that I could have added here, but this is what basically comes out of that. Yeah. And when you have those paths, you can now basically have a look at what point in time which of the paths is going into default, which means when is the debt level, yeah, the nominal debt level, the 40 of debt, more than 6 times higher than the EBITDA. Yeah, so for example, here on that path, that happens in year number 4. And then it's really a simple counting of paths. Yeah? Then you can really say with a count ifs formula, okay, how many of those paths have defaulted in a certain year? Yeah, and then you have already a nice model which can tell you what is the probability of default. Yeah, and then what you can also do, and yeah, I hope that is still meaningful, although I'm now jumping a bit, but time is too short to like really show all the technicalities here. Yeah, so that would be something which we do in this Excel training or in those webinars that we do with NIRV. So here that's really just to give a little bit of an overview. But on that next sheet, I have basically replicated this whole idea of random paths, but this time in risk-neutral probabilities. Yeah? And with those risk-neutral probabilities, just to put it in a nutshell, the great thing is, so let's say you are making the outcomes a bit adverse, yeah, a bit worse off, yeah. So you are using a drift rate that is lower, but in the same moment you are also allowed to basically discount all the payoffs that you have on the way with the risk-free rate. Yeah, so that's basically the little shift you do. You make the outcomes a bit worse, but then you can basically always go with the risk-free discount rate. Yeah, so that's really in a nutshell how that really works. Is also something that we would need to discuss in a longer webinar. Yeah, but just to give you the glimpse of the idea. So then you have basically those risk neutral paths, and again we can count at what point in time is which of those paths going into default, and then we can have a look, okay, in those years where we are not in default, what is the coupon payment that the debt holders get, yeah, and if the company is not at all going into default, then at the end, after 7 years, the debt holders basically get the coupon payment plus the nominal value of debt, yeah, so 42. And then you have other paths, for example, path 3 here, where you get the coupon 3 years in a row, but in year 4, you basically go into default, and then you are left with only 24.52, and that value simply comes from the fact that we have a certain value of the company, asset value of the company, that is also attached to the EBITDA. And from that, 40% of bankruptcy costs are deducted, and only what is left is then basically transferred to the debt holders. And this is where the 24 are coming from. And once you have that, and it's really just counting paths and putting payoffs to the different paths, then you can basically come up with expected values, expected cash flows, so to speak, per period, which you then simply discount with RF. Yeah? So that's what's happening here. Yeah? So you're discounting this with the risk-free rate, and putting it all together basically gives you, you can see that down here in the sum, gives you the market value of debt. Yeah? And that's the overall idea of that model. And now obviously you can play around with that. I will just do one little tiny thing because otherwise we are overshooting in timing. But let's say if that would be a debt contract which starts now, yeah, nothing that has already been running, but something that would just start now. Then in t equals 0, so now I would basically set a promised yield that makes the market value of debt equal to the nominal value of debt, right? So let me play around with that. So at the moment with a promised yield of 5%, I only have a market value of 35. So maybe I go for, I don't know, 7%. That brings it close. Oh, and one important thing, for the moment, please have a look at this first number, yeah, which is the market value of debt with risk neutral probabilities. The other one is something we have to calibrate with the expected return of debt or the expected cost of debt. Okay, let me go a little bit further, 7.5, that works pretty fine. Yeah, let's leave it with that. So a promised yield of 7.5% in our case here would yield a market value which equals the nominal value of debt. Yeah, and then in the next step, I could basically try to figure out now what is the expected return of debt that mimics exactly this value of 40. Yeah, so I guess, I don't know, let's see. Okay, maybe 4.8, it's too much. 4.75 comes close, yeah. Pretty close, yeah. So I stopped it here. But with such a model, I'm basically able to always play the triangle of what is the market value of debt, what is the promised yield, and what is the expected return of debt. Yeah, and whatever you are in that moment looking for, you can basically determine it with this simulation model here. Yeah. Okay, I hope that was not like a total overload and rather showed you a bit the power of such a simulation model. If there are questions, now would be a good chance, but you can also ask later. I don't see questions for the moment. Okay, so then I would stop my screen sharing and hand back to Professor Schwetzler.
Okay, thank you. Now I have to share my screen again. Do you see the presentation or do you see the split?
No, we see the presentation. That worked fine.
Still, because I now changed it.
Really? No. So I see the presentation. I see the
Okay.
slide. So it
Okay, that's good.
Should be all good. Should be all good.
Okay. So yeah, one thing that came to mind was I said that under COVID-19, the market value of debt may have declined due to the declining creditworthiness, and that, of course, by the same token, the market value of equity has increased. That is, of course, only relating to the impact on the value, the market value of debt. So usually, of course, the direct impact of COVID-19 on the market value of debt is way, way more severe and overcompensating this, in that sense, tiny benefit that you have, that the debt holders are also forced to suffer a bit jointly with the equity holders. Yeah. So just to make this clear. Yeah. So in that sense, the overall impact usually is way, way more negative. And maybe it is a bit curbed, so to speak, by a decline in the market value of debt as well. Okay, so now let's look at cash. I also have some questions lined up here that I think might be interesting. But of course, as I said, we are open to any suggestion from your side as well. So again, the same question, market to book value,
So now we don't see a new slide. It's still the one from the simulation model.
Okay. Let me go back. So what do you see now?
Yeah, so now we see a questions list.
Okay, but the full slide.
Yes, the full slide.
Okay, so
yeah.
Should have a new notebook, huh? Okay, and the second question is one that I think many of you also have on the table right now. That is, some of the owners have deep pockets, and that is especially true for private equity owned firms. And of course, I mean, as you know, private equity has A, deep pockets, and B, a lot of dry powder. And so, of course, they can step in and contribute fresh equity to the firm if it is needed. And so the question is then, is this having an impact on the value of the company? Probably, I think. And how shall we, if at all, reflect this in the valuation? Yeah. And also a similar question is then the other way around. If a firm already has enough cash aboard, and we talk about excess cash. So I do not open today the Pandora's box distinguishing between operating cash, which is used to grease the business and is by definition worthless, and excess cash that actually is valuable because it may generate interest income and be used for other things. Yeah. And in order to answer this question, I will borrow a bit theory from the financial theory, because there is abundance of research results with respect to bright sides and dark sides of cash. Yeah. So that's the overall questions. Yeah. So what is the potential impact of credit lines of high cash reserves on the one hand, and potential deep pockets of the owners of the firm on the other hand? And as I said, there is significant evidence from many research studies that have been done on the corporate finance side. So if we just look at the value of excess cash, which is not too surprising, if you have cash aboard, then this cash is the more valuable the lower your access is to credit and equity markets. Yeah? So in that sense, cash aboard is very valuable for SMEs, small firms that don't have, in that sense, easy access to credit by banks, and perhaps no access at all to fresh equity. Yeah? The second thing is here, the valuation of cash by the capital markets depends on whether you have good or not so good growth opportunities. Of course, biotech firms, for instance, have a high cash level to give them the exercise capacity in that sense to invest into the next round of research if a certain test is passed. So the capital market is quite fine with cash in growth companies, but the capital market is not very fine and is more skeptic if mature firms with low growth perspectives hoard cash, yeah? Because then, and that's the next point here, then the capital market fears that, and that should be a minus actually. Yeah, sorry, that comes from making your own slides. Please change this mentally into a minus. Because if the corporate governance is bad, then firms hoarding cash in that sense are always suspects in burning this cash in stupid transactions. Yeah? Or, I mean, we may leave the plus here if we interpret that way, that we say, if the corporate governance is good, then of course the capital market is less skeptic that these high cash reserves are used for stupid transactions. Yeah? And there is ample evidence that the acquisition performance of firms that hoard cash is significantly lower than the acquisition performance of firms that first have to go to the bank or to the credit market, raise the money that they then spend on corporate transactions. So governance, as we'll see later on, is a very important aspect when capital markets judge cash holdings of firms. Yeah? The level of legal protection plays a role. That is a study that I would like to show you later on, because especially if you are in a minority position, then minority shareholders are always exposed to tunneling strategies that the majority owners somehow find a way to siphon the money out of the firm and into their own pockets. And that means that high cash levels of a company under low legal protection in that sense are still not too valuable for minority shareholders because they won't see anything of this cash. And finally, here, cash is in that sense less valuable if you have owners aside that have deep pockets and that are willing to support you. Yeah? Because then, of course, if you have access to cash, straightforward and easy access to cash, then it is not that crucial that you have, in that sense, the cash aboard. Because, as I said, if you need some, then the owners will step in and bring fresh cash to the table. And that's, by the way, something we do a lot of research on private equity. That's something that recently has been a study, recently 2 years ago, by Josh Lerner from Harvard, who showed that in crisis times, portfolio firms from private equity owned or private equity owned companies reduce their investments less than average firms in the same industry. Yeah? So in that sense, many investors expect, or many practitioners expect this to happen as well in this crisis. Yeah? That the deep pockets of private equity are a benefit to their companies. How could we turn these results of empirical research into, in that sense, a hands-on valuation? That's tricky. That's really tricky. One way to look at this might be that you say, if you are short in cash and if you are, in that sense, not having easy access to credit and new equity, then of course you are exposed to potential value destruction or lost values by not being able to realize all good projects that are in hand. Yeah? So maybe the cash drain due to COVID-19 forces you, in that sense, to reduce capex, despite the fact that you are convinced that this capex, technically spoken, carries a positive net present value. Yeah? So in that sense, the approaches that are quite complicated, that's why I do not show it here. The approaches that, in that sense, try to value or to come up with a discount on the value of the company due to, in that sense, a low level of success, always try to model this as, in that sense, lost opportunities, yeah, that you are restricted in your financing and you cannot exercise all good opportunities that come along. Yeah? And technically, a model that I mean, I'm a researcher, I can afford to say this, that I like very much is a working paper by two authors. And they said that if you hold cash, then you may value this cash as the difference between an American option that can be exercised immediately and a European option that can only exercised at terms. And the idea behind that is that if an investment opportunity comes out of the blue, and if you have enough cash, then you can do it immediately. You don't have to wait. Yeah. So that's the American option. And if you have access, but you have to organize this, you have to raise new debt, and you have to perhaps raise new equity, then of course, exercising this option may cost you some time, and that is then reflected in the European option. And so, and the difference between the two then is the value, yeah, of the additional option value of cash, that if you have it at hand, then you can easily, in that sense, realize any investment opportunity that out of the blue may appear. Yeah? But as I said, already this is quite complicated, and I have to admit, never seen any of these models to be applied in corporate valuation. That's why I also decided not to show them here. So that's the study that relates to this legal environment. That was a famous study by René Stultz, and he found out that in countries where there's a high level of investor protection, the value of $1 cash is roughly $1 in firm value, whereas in low-level protection countries, that is less developed countries, it is only 65 cents. Yeah? So in that sense, the loss in value due to this potential tumbling and exploitation by the majority shareholders is 35%. Yeah? So as I said, I would not like to show some of these complicated models. I just would like to highlight perhaps a way to practically deal with that. Yeah? And I think a good way to start with is that famous one-to-one rule, that I say, okay, a $1 cash on corporate level or €1 cash on corporate level as a starting point should have also a value of €1 or $1, yeah, in equity value. Yeah? So that's a good starting point, because on a perfect capital market, and I like this as an assumption, as a starting point, as I said, this is going to hold. Yeah. So, and now I have lined up some arguments that I have collected from practitioners against the one-to-one rule from the downside. That is, arguments that are brought forward that €1 cash has a value that is less than €1. And finally, some arguments in favor for larger than one-to-one. And I just would like to line them up and in that sense arm you for your negotiations with your clients. Of course, you may then rely on, depending on which side of the table you're sitting, the one that is best suiting your client's need. So the first argument that comes along is a tax argument. Yeah. And that is quite correct, because if you think about it, in a particular sense, cash is like negative debt. Yeah? So negative debt costs you interest, cash produces interest income. Yeah? And of course, as usually, interest income, if there is any, of course, interest income on corporate level is taxed heavier than interest income generated on shareholder level, because you have to pay corporate taxes, and if you pay it out as a dividend, then usually in Germany there comes another shareholder tax on top of this, whereas if you hold $1 cash on shareholder level, you just pay the return that the cash is going to generate, yeah? And so you may justify then, in that sense, a discount on the cash because it does not earn its cost of capital, yeah? And that is a misconception of the WACC approach, yeah? Because of course, the WACC is the overall cost of capital of all assets of the firm, yeah? And it just says that the average over all assets of the firm have a WACC of maybe it's 8%, yeah? But if you just look at cash in particular, of course, you have to compare the rate of return of the cash against the cost of capital of cash, yeah? And if you think about the risk property of cash, I mean, cash carries a beta factor of 0. So what is the required rate of return, and the cost of capital of cash and the cost of equity of cash is, of course, again, the riskless rate, yeah? So in that sense, this is the WACC fallacy, the famous WACC fallacy, that you apply the WACC even though you have calculated properly for the entire firm. You applied on particular specific investment opportunities or assets that definitely do not have the average risk of the firm, that have a lower or a higher risk, yeah? And finally, an argument that is quite popular in private equity environments, that you say, well, I cannot take the cash out of the firm because maybe I do not have enough retained earnings to withdraw it and the like. That is not an argument, because of course the value of cash as present value of the interest income that is generated by it is still valued. So in that sense, this is simply the reverted argument that we have had earlier with respect to down payments of debt. Yeah. So in that sense, you don't need to pay the debt down to, in that sense, pocket in the benefit of a lower market value. And this is simply the revert argument. You don't have to take the cash out of the firm to have the benefit of it. You simply have to pocket in the interest income of it. Yeah. And finally, there are some arguments in favor of the one-to-one rule. For instance, here, saving transaction costs. That is especially important if you are working in the private equity environment. Then, of course, I mean, then if the firm has a roll-up strategy and buys other firms, then of course it does not have to raise fresh equity and take transaction costs into account. Yeah, and there is even a tax argument in favor for high cash holdings, and that is attached to this trapped cash story of the U.S. firms holding cash. I think Apple has a cash balance in Ireland of, I think, 140 billion US dollars, and the argument behind that is the repatriation of this cash to the US would, of course, cause taxes. In the good old days, before Trump reduced the corporate tax rates, it would have been 35%. And that means that $1 cash kept in Ireland actually consists out of 33 cents tax credit given by the US taxpayer. And so even if this cash balance in Ireland is producing very, very low interest and is even taxed higher due to the argument above, then the fact that 35% of the money is coming along for free is overcompensating this higher taxation of the higher taxation of the interest impact. Yeah? So in that sense, if you have cash that is containing a tax credit from the taxpayer, then this trapped cash calculation may even end up in a favor for the shareholders. So of course, Apple shareholders are better off Apple hoarding this 150 billion cash instead of paying it to them, because the amount of money that would end up in the pocket of the shareholder would be 150 times 65%, because Apple would have to pay taxes on that. Yeah? So in a nutshell, that was the overview of some arguments that you may find helpful to use in your day-to-day business. As I said, I abstain from showing you some complicated equations. And that means that all these arguments end up then to be transposed into rules of thumb for your valuations. And of course, you, in that sense, should not be ashamed to use that because, as I said, the valuation models from corporate finance theory, in that sense, are hardly applicable in practice. Yeah? Okay, so time's up. I have overdone a bit. I'm sorry for that. But of course, now we are happy to answer any question that may come up from your side. Thank you for your attention.
Yeah, and again, you can use the group chat for that, or I would say now you could also unmute yourself if you have a question either on the risky debt part or also on the cash part. Okay, so there is a question in the chat, Professor Schütze, I'm reading it out. Okay. If I get a prepayment today of 1 million, I cannot account for it in working capital as well as cash. I would have counted double. There is no question mark, but I guess it is meant as a question. Yeah, okay.
Okay, yeah. So of course, I mean, this cash position is then not to be counted to net working capital. Yeah, so it's directly in that sense an excess cash position. Yeah, but I also would recommend only that open the Pandora's box of distinguishing between operating cash and excess cash. I would take this cash as an excess cash position. Yeah, because of course you're right. If you would add it on both sides, then of course it would net out always to zero. Yeah. So again, how would I, just to take the next question that may arise from this, how would I take operating cash into account? Well, usually, I mean, you know how it is. You would simply, I would link it to the sales figure of the firm. Yeah, maybe in certain industries, perhaps 5% of the sales are always used as cash just to grease your operating business. Yeah, so in that sense, and that means, and that's important, perhaps, that it's not just, this assumption is not just affecting your current operating cash, that of course is not part of the equity bridge then. It will also affect, if the firm is going to grow, by the growth, of course, also your future cash flow. Yeah. So, because of course, if the sales are going to double over the next 5 years, the necessary cash to grease your operating business will also double. And of course, that means that you have to set aside a part of the money of your free cash to finance the increase in your operating cash balance. And that, of course, will reduce the free cash flow. Yeah? Because many or some practitioners think that this discussion is only important for the current cash. This is not true. On the DCF, it is also, of course, depends on the growth. But if there is growth, it will also affect your free cash flows in the future. Yeah?
Okay, is there any other question? Otherwise, I would take this one question that I received, or we all saw during Professor Schwetzer's presentation of the cash part, which was still related to the debt, and which was basically asking where the spread of the expected return of debt and the promised yield is coming from. And I already answered in the chat that this is not due to any risk neutral valuation magic that is going on, but it's really because of the riskiness of the debt or the likelihood of default. Yeah, so the higher the debt level that I put into the company, the higher the risk of default and the higher the promised yield has to become in order to make that still an NPV zero game, so to speak, for the debt holders. Yeah? And therefore the promised yield is increasing heavily in comparison to the expected return of debt. And maybe I can just quickly share my screen.
Just to add and highlight this,
yeah, please.
Both are increasing in credit risk. Yeah? So in that sense, of course, the expected rate of return and the cost of debt are also increasing in credit risk, but way lower than the promised one.
Yeah.
So both increase, but as I said, the gap between the two is widening at increasing credit risk.
Exactly, yeah, and like in a good cooking show, I used the time when Professor Schweitzer was presenting the cash part. I prepared a little example. So now you should see my Excel again, and if you remember, last time I had here a nominal debt of 40, and I think it needed 7.5% as a promised yield to make that a fair debt contract. And then we had, this one I forgot, I think it was 4.75% or something, roughly, yeah, a bit less. Okay, 4.7%, yeah. So here the gap is now from 7.5 to 4.7, yeah, so 2.8 percentage points when the debt level is 40. That is already a heavy debt burden if we consider that the EBITDA is 10 and that the covenant is at 6, yeah. But still, let me increase that to 45. So then basically to make that a fair debt contract so that the market value equals the nominal value, we would need to increase the promised yield, I believe, to 9%, yeah, pretty much. And then we would need to play around a bit with the expected return of debt. Yeah. And you see with roughly like 5.1%, you come to a market value of debt that equals the nominal value of debt. And now obviously the gap has increased. Yeah, so both rates have grown, but basically the gap between the two has grown further. And the more we go downwards, the risk of default is decreasing, and then also both rates are coming closer and closer together. By the way, down to the point that if there is no risk of default, not at all, then at least conceptually, the promised yield and also the expected return of debt should come down to the risk-free rate. Yeah. Okay, yeah, so I hope that clarified the issue a bit, although you now don't know all the formulas behind, but at least from a conceptual point of view. Yeah. Okay. Yeah. Okay, very good. Is there any other question left? If not, then we would like to thank you. Yeah. I hope for you it was also an interesting session where you took something out of it. I think we enjoyed it pretty much, if I can say that for both of us. Yeah.
Yeah.
And we are already pretty much looking forward also to the webinar series that we are going to start and shortly going to announce with NIRV, which will then basically run on a continuous basis, I think roughly like once a month, and then also in a longer format, and which is also part, let's say, of NRV's overall seminar or training schedule. Yeah, and we are already pretty much looking forward to that. And I think everyone who participated today will then also receive some more information on that. Is there something left to say, Professor Schweitzer? Something I forgot?
No, some final last words.
Yeah.
We had fun. And so, yeah. Any suggestion that you want to make, of course, is welcome.
Yeah.
Of course, we want to improve. If there is something to improve, then of course we'll be happy to do so. So thank you for your time and hope to see you soon in one of the other webinars. Bye-bye. Thank you.
Bye. Thank you very much.